Do you have questions about a reverse mortgage or what a home equity conversion mortgage actually is? There's a lot of different stuff going on back and forth right now with what that is and whether it's good or not for you. So we're here to kind of clarify some of those things and help you make the right decision in your retirement. My name is Dave. I'm with Fairway Independent Mortgage, and we are one of the largest reverse mortgage lenders in the country. So we're here to kind of dispel some of the myths and rumors that surround a reverse mortgage so that you can get the right information to see if it's the right type of financial tool for you. Are they right for everybody? Absolutely not. But could it be right for you and help you live a more fruitful retirement? Absolutely. And there's lots of strategies that we use with the reverse mortgage to help you make the right decision for your family. So the first thing we're going to do is we're just going to kind of go over what a home equity conversion mortgage is, and why we call it a home equity conversion mortgage. We also refer to it by its acronym of HECM. So home equity conversion mortgage, or HECM, is exactly the same as reverse mortgage. So all those things can kind of go together. The term reverse kind of has a bad connotation to it because a long time ago, these were not the best financial tool, but since the FHA stepped in and they changed some of the lending laws surrounding reverse mortgages and how home equity conversion mortgages work, they are absolutely tools that when used the right way, can help benefit you in your retirement. So all home equity conversion mortgage is a way to access the equity in your home so that you can turn it into spendable cash to help you with expenses in retirement. It can be part of a comprehensive retirement strategy that you can put together with your financial planner. We work with a lot of financial planners, a lot of people in retirement to decide what's best. Is it best for them to take money from their 401k? Is it best for them to access the equity in their home? These are things that you want to look at with a team of people, which we can help you find, that will help you make the best of your retirement. So when we see people and start talking to them about retirement, there are typically three buckets that we look at for their income. The first one is wage income from what they're doing for a job. A lot of people like to work in retirement, whether that's a full-time job or a part-time job. And so we're going to look at that. We're going to look at the income from your savings, investments, pensions, anything that you have from a former job, 401ks. And we're also going to look at access to your home equity. That's where the reverse mortgage comes in, is accessing that equity and which type of access works best for you, because there are several ways to access that money. Let's start with the requirements of a home equity conversion mortgage. Again, these are not for everyone. So the first thing you must have is you must be 62 years of age. That is just a requirement that the FHA put in and said, hey, look, we're not going to do this for people that are young, so you must be 62. Second thing is you must have significant equity in your home. And it's going to vary depending on your age. The younger you are, the more equity you have to have in the property, because you're going to live longer, so there needs to be a little bit more of a cushion there for the bank. If you're older, you don't need as much. And then the only other we'll call a quote unquote requirement is that you must continue to pay your taxes and insurance. So that will be paid outside, generally, of the reverse mortgage. We can set something up where the taxes and insurance are paid, but generally, you will continue to pay those outside of the mortgage. So next, what are the benefits of a reverse mortgage? One, the equity that we take out of your home and turn into spendable cash is non-taxable, which is a huge benefit in retirement, especially if you're taking required minimum distributions from a retirement account. This is equity in your home. This is debt. So there is no tax liability. You don't have to claim it on your taxes or anything because it is debt that you're spending. The second benefit to this is that there are no principal and interest payments required. That's the benefit of a reverse mortgage. You do not have to make your monthly principal and interest payment. And then, depending on the amount of equity that you have in the home, one of the greatest features of a reverse mortgage, if you have enough equity, is to be able to get a line of credit so that you can access throughout retirement You can pull money off of it. You can pay things back down and gain on that line of credit. There's a lot of benefits to that we're going to get into later. So the main benefits are you're going to get the money tax-free. There are no principal and interest payments required in a reverse mortgage. And depending on the amount of equity you have, you could be able to establish a line of credit. So let's get into that line of credit real quick, because that is really one of the most interesting aspects of this, and a little bit it's one of the harder ideas to comprehend, because it is a reverse mortgage. This line of credit operates in a different manner than a normal line of credit. This is actually my favorite part of the reverse mortgage. One, if you do need money off that line of credit, you get to draw that money off the line, utilize it for whatever expenses you have, and there will never be a payment required to pay that money back. So you can access the equity and there will never be a payment associated with it. Here's where it gets a little tricky. The unused portion of the line of credit that you have, let's say you have a $100,000 line of credit and you've used none of it. That line of credit will grow every single year that you don't access all the equity. So anything that's unused, let's say you started with a $110,000 line of credit, you borrowed $10,000 and used that, you spent it. There's no payments associated with it, and you have $100,000 available to you on the line. That's going to grow at the interest of the loan. So if your home equity conversion mortgage happens to have a 6.5% rate, that $100,000 line of credit would grow annually at 6.5%. That's compounding. So every year it gets bigger and bigger and bigger. So you'll have access to more and more money through that line of credit as the years go on. So in a home equity conversion mortgage, there are 3 ways that you can access the equity in your home. The way we're going to figure this out is we're going to sit down with you, your financial planner, possibly your tax person, and we're going to figure out what works best for you. Which access point provides you the most benefit in your retirement? So the 3 ways you can access the money are: at the initial close of escrow, we will give you part of your equity. That's called the initial draw. So if you need $50,000 right away, that's part of the initial draw. You'll get that at the closing table. You can do what you want with it, pay bills, go on vacation, whatever it is. The second way you can access the debt in your home is through monthly distributions. We can set it up so that you will get monthly deposits into your bank account from the equity of your home. So if you're short on your monthly expenses, let's say $500 a month, and if that $500 would get you over the hump and it would help you pay your bills, we can set up a monthly distribution in whatever amount you decide you need, and then we'll just leave everything else to the line of credit. So if you need those monthly distributions, we can do that. The last way to access the money is through that line of credit that we previously discussed. So we have an initial draw that you can collect money at the close. You can have monthly distributions to generate income, or you can establish a line of credit. So the great part about this is you don't have to necessarily pick one. You can use any combination or all 3 of those ways to access the equity in the home, if that's what works best for you. So it's one of the 3, all 3, whatever fits your situation best. Now, there are some strategies to doing this too that could benefit you, your heirs in the future, and we want to work with your tax advisor and with your accountant to make sure that we're doing the right thing for you. The first thing is, by accessing the debt in your home and living on that instead of your investments. See, sometimes people get stuck with the market maybe dip down a little bit, but then they need the money out when they should have waited for the market to rebound a little bit, maybe gain a little bit more value in their investments before they withdraw the money, because you never want to take the money out when it's down. You can actually just access the debt on your home by the use of a home equity conversion mortgage or a reverse mortgage. You can access that. And then when it's a good time and we decide with your accountant or your investment strategist that it's a good time to draw money off those investment accounts, we can do that and pay the home equity conversion mortgage back down, therefore opening up that line of credit again and giving you access to the debt. So that's a little strategy that we can use, and we're happy to work with your financial planners, advisors, tax strategists on what's the best way for you to not only utilize this money, but to get it out of the house. One of the other strategies that we have here is you can use a home equity conversion mortgage or a reverse mortgage for purchase. This is not just a strictly refinance tool that you're going to use. This can be something that you use to purchase a home. So for example, I had a client that just recently moved from California. They sold their home over there. It was about $1 million home. It was actually about $875,000 home that they sold over there. They'd lived there since the early 70s. And so it was, of course, paid off. So their concern was what they wanted to do was move to Nevada because we are a retirement state. People love to come here and retire. We got great weather, lots of things to do, lots of places to eat. They wanted to just come over here. They wanted to buy a house for $400,000 and put the rest into an investment. But they wanted to pay cash for a house 100%. But when they got here and started looking in that price range, it wasn't what they had become accustomed to, and it wasn't the style of house they wanted to live in. What they really were was shopping in about the $650,000 range. But then that didn't leave them enough money to invest and then live the retirement that they wanted. So what we did for them is we put them in a reverse mortgage. They were able to put that $400 and something thousand down and get the home that they wanted, which was in the $600,000 ballpark, which was great for them. They were able to put that money down, use the reverse mortgage to purchase the home. They'll never have a principal and interest payment. All they got to do is pay the taxes and insurance, and they're good. We put the rest of the money with their financial advisor, who then invested it in the market or whatever strategies they wanted to do over there. It was really a win-win all the way around, and really great for this family when they moved over. So that's the gist of the reverse mortgage. We just want to make sure that you're 62 years or older, you have significant equity in your home, and that you need or want access to that money in retirement. If these things sound like they would help you in your retirement, or perhaps you want to just talk about what different strategies look like, my contact information is below. Please reach out to me and we'll go over how this unique financial tool can help you in retirement.